One of the most common mistakes we see investors make, particularly in their 401k, is that they move into bonds at the absolute worst times when interest rates have dropped and the prices have already climbed. We saw this in 2020. As the stock market was going down 30% in 30 days, interest rates were simultaneously dropping down to zero, to the point where the 10-year treasury was roughly 0.5%. And in that, they look and say, oh my God, these treasuries, which seem really safe, are going way up in value. Everything else is going down. I'm going to sell these risky stocks and go into these bonds, which are doing great, and they're really safe. But the problem is, a bond's return is highly correlated to the interest rate at the starting point. And that should make sense. A bond is simply a stream of cash flows that are going to be paid over a set amount of time. If you have a 10-year treasury, for example, that's paying 5%, it will pay you 5% every year for 10 years. At the end of 10 years, you get your principal back. And so if you have a 10-year treasury and it's paying 5% a year and interest rates go down to zero, it'll look like you make a tremendous profit in the blink of an eye. But what that's telling you is that, for example, you are going to get 50% spread over 10 years. Interest rates are now at zero. Someone looks at your income stream and says, wow, current rate zero, you're going to get 50% over 10 years. I will give you a 40+% premium for that bond, and we'll be all square. So in the blink of an eye, you make 40+%, but in years 2, 3, 4, 5, 6, 7, 8, 9, 10, it's going to look like you're making essentially zero. So this chart, what we're simply looking at is that interest rates are the leading driver of bonds' long-term returns. So when we look at bonds today and we look at 10 years from now and the total bond return expectations that we have, what we see is that because we're at higher starting rates than we've been in quite some time, we expect that bonds are going to have higher long-term returns. This is not a magic trick. It's not even trying to look into some crystal ball predicting what happens in the future. It is simply saying that because we are starting at a higher interest rate, we should have better long-term returns in bonds, regardless of what happens in the short term. If interest rates stay flat, it'll look like we're making consistent returns along the way. If interest rates shoot down to zero tomorrow, it'll look like bonds make a huge, huge windfall in a short amount of time, and then they have very low returns thereafter. And if interest rates were to go up further, it may look that bonds are doing poorly or underperforming, but that simply means they're going to have higher returns in years 2, 3, 4, 5, 6, 7, 8, 9, 10. So that's how bonds work, and that's how we make our assumptions about our forward-looking returns in the bond world. If you have questions about this or anything else, just let us know.